Let me guess. You open Zillow just to browse, you find a house you love, it's $550,000, and you think, okay, maybe if I stretch a little. Then you check your bank account, and suddenly you're doing emotional math. Okay, but if I just put 5% down, and maybe rates drop, and maybe I get a raise, yeah, that's literally you. And here's the uncomfortable truth. Most people have no idea how much house their salary actually buys them. They're shopping based on vibes. My name is Nikki, and I spend way too much time thinking about housing affordability and how people accidentally sabotage their financial future. If you're someone who feels stuck between I want a house and why does everything cost $500,000, make sure to hit the subscribe button and give this video a thumbs up if this helps you out. Because today we're doing real math, and some of it might hurt. The myth, if I can get approved, I can afford it. Look, here's the thing. Banks do not approve you based on comfort. They approve you based on risk tolerance. In 2026, most lenders allow a debt-to-income ratio of around 43%. That means up to 43% of your gross monthly income can go toward debt, not just your mortgage, debt. Student loans, car payments, credit cards, and that's before you even buy groceries. Let's do real math. Say you make $100,000 per year. That's about $8,333 per month before taxes. 43% of that is about $3,583 per month. That's the maximum debt payment lenders may approve. Now let's isolate housing. Most financial planners suggest keeping housing at 25 to 30% of gross income. 30% of $8,333 equals about $2,500 per month. That's your safe housing budget, not your emotional budget, your safe one. So what house does $2,500 actually buy? Let's assume 20% down, 7% interest rate, 30-year mortgage, property taxes, and insurance included. At current rates, a $2,500 monthly payment roughly supports a home price around $375,000 to $400,000. That's it. So if you make $100K, you are not realistically in the $600K neighborhood, even if Zillow tells you otherwise. Now let's break some hearts. If you make $70,000 per year, that's about $5,833 per month growth. 30% housing target is about $1,750 per month. That supports roughly a $260,000 to $300,000 home at current rates, and this is where people spiral, because in many cities that barely buys anything. But Nikki, I can just put 5% down. Okay, now we're talking psychology. Here's what most people don't realize. Low down payments don't just increase your loan size. They increase your monthly payment, your interest paid over 30 years, and your financial stress. Let's say you buy a $500,000 house. 5% down is $25,000. Loan is $475,000. At 7% interest, you'll pay over $650,000 in interest alone over 30 years. That means your $500K house costs you over $1.1 million total, and that's before maintenance. This is where it gets really interesting because the emotional driver isn't math, it's status. The psychology of bigger house equals success. Humans are wired for comparison. You see your coworker post a closing photo. You see your cousin buy in a nicer neighborhood. You don't want the starter home. You want the forever home, right now. But here's the thing, a house is not just a payment, it's a lifestyle decision. Higher payment means less investing, less flexibility, more anxiety during layoffs, more stress during recessions. And according to financial stress studies, housing costs are one of the top contributors to anxiety in middle-income households. No one posts about that part. Now, you might be thinking, okay, so should I just never buy? No, but you need clarity. Ask yourself, if your income disappeared tomorrow, how many months could you cover your mortgage? If the answer is maybe one, you're buying too much house. The real formula. Here's the framework I personally like. Keep housing at 25 to 30% of gross income. Have 6 months of total expenses saved before buying. Still be able to invest at least 15% of income. If buying the house destroys number 2 and 3, you're house poor. And house poor is not wealth. It's trapped. Let's compare two people. Person A buys at their maximum approval, $3,500 per month mortgage, invests nothing extra. Person B buys at $2,200 per month, invests the extra $1,300 monthly at 8% return. Over 30 years, that $1,300 invested monthly becomes over $1.7 million. Same income, different decision. That's the invisible cost of stretching. But real estate always goes up. Look, over long periods, yes, historically home prices in the U.S. have appreciated roughly 3 to 5% annually, but leverage cuts both ways, and appreciation doesn't matter if you can't breathe financially for 10 years. Plus, maintenance averages about 1 to 2% of home value per year. On a $500K house, that's $5,000 to $10,000 annually. Roofs don't care about your budget. So how much house should you buy? Here's your quick calculator. Take your gross annual income, multiply by 2.5 to 3. That's your comfortable price range. If you make $100K, aim for $250K to $300K. Yes, it feels lower than Zillow says. That's the point. Action steps you can do today. Calculate your 30% housing number. Factor in taxes, insurance, HOA, maintenance. Build a 6-month emergency fund before buying. Compare investing the difference between max approval and comfortable payment. Then decide, not emotionally, mathematically. Look, buying a house is not a race. It's not a status badge. It's a financial lever, and levers amplify whatever foundation you already have. Strong finances, it builds wealth. Weak finances, it multiplies stress. So before you ask, how much house can I get approved for, ask, how much peace can I afford? Because long-term wealth isn't about impressing people for one day. It's about sleeping well for 30 years. If this helped you rethink housing, hit subscribe and tell me in the comments, are you shopping based on approval or affordability? Let's build smarter.